Hey, Tilda Moschetti here. Hope you are doing well. Coming to you live from North Carolina. Wanted to welcome you to this webinar. Today, we're going to do a lot of very cool things. We're going to go through underwriting, but we're going to do it in a manner that you probably haven't seen before. Web underwriting itself or financial analysis is probably considered one of the most boring things you could do by many syndicators. I actually find it extremely exciting, and you'll see why. Once we dive deep into the financial analysis picture, and when you look at it from the concept of levers, which is what we're going to talk about, you'll see that there's a lot of possibilities and how you can shape deals into deals that not only work really well, but also work very well for your investors. At the end of the day, what we're trying to do is we're trying to build an investment that investors will invest into, but will still make you the most amount of money. So a lot of times how I approach the financial analysis picture is I start with my FIT, right? The founder investment theory. And I've got videos on that, and I'm sure you've heard me talk about that before. But when you start with the FIT and you get an idea about what your investors are looking for, not only from a financial picture, but also from what sort of deal in general they're looking at it from, what sort of lens. Are they looking at it as a cash flow deal? Are they just needing a long-term thing? What's going to get them excited? Those things. Then you can start to build your investment offering in a way that really dials it in specifically for those investors. So starting in the financial analysis picture, we start with, the typical things that you might see in advertising. So what do my investors expect to see in terms of IRR or expect to see in terms of some sort of multiple or something like that? The problem with that is that we see, and you see this on advertisements all the time on Facebook, is all that syndicators are talking about is those measures. It's, hey, we've got a 15% IRR. We've got a 15% IRR. I mean, if you scroll through my entire feed on Facebook, because I click on every single ad that syndicators put out, is just full of these. And it's just IRR after IRR after multiple after multiple after IRR after preferred return, IRR. And there's nothing at all interesting, which puts syndicators in the role of just a commodity where you're competing on IRRs, multiples, preferred returns, things like that. And what that does at the end of the day is it puts you in a spot where now you're competing on as a commodity. You're trying to give investors the highest possible return possible, even at sacrificing at yourself. There's a lot of ads right now that are competing saying, well, our splits aren't 80% like everybody else. Our splits are 95% to the investor and only 5% to us. What that's ultimately going to mean for the syndicators is, unless they're really padding their fees, which they are, but unless they're actually, if they were doing it correctly and not padding their fees and just doing those 5% splits to them, they'd be out of business. They would be doing way too much work for not enough reward. So let's go through sort of a high level in terms of how do we do financial analysis and how we break things down. Of course, you can do questions. There's a Q&A in the bottom. Feel free to use that. I'm not going to be checking it too much because I want to go through in detail a lot of these, but certainly towards the end, I'm hoping to have enough time. But there's a lot of information I want to go through. And so let's go ahead and get started with that. So let's open up a whiteboard. If you've seen my webinars before, I love the whiteboard. It gives me a good chance to put everything down in a nice place. So when it comes to financial analysis and when it comes to writing a pro forma, so even your real estate agents, when they're building a pro forma, there's two sets of things that are going on at any given time, right? They're looking at facts and they're looking at assumptions. This is how every analysis starts, with those two items. So what are the facts? We've got simple things like size of the property, And by the way, I'm going to use like an apartment building as a sort of a template here. Most of my clients are syndicating multifamily properties. It's just a starting place. It doesn't matter if this is real estate, if it's multifamily real estate, if it's an office building, which hopefully it's not right now, if it's a multi-tenant retail building, which hopefully is a great asset class right now, or if it's something else entirely. This is the same sort of thought process, is that everything starts with facts and assumptions. So we've got the size of the property, we've got the lot size, you might have the FARs, you've got the existing tenants, and you've got other factors too, right? It's located in somewhere, and that somewhere has demographics. You've got the operating expenses of today. You've got property taxes. You've got, if you don't own this asset yet, you've got the fair market value, which is the price you're paying for it, right? You're buying this property for something. And so you've got this set of facts. There's other facts too, and we'll get into some of those in just a second, but let's talk about some of the assumptions that are going on. Well, we're talking about existing tenants. So what is the likelihood of renewal, right? If they're on a lease, what's the likelihood they're going to stay and renew? That may change everything, right? So in some places where there's rent control, you may not be able to move tenants out. If they're planning, and if they renew, you're not going to be able to increase the value or redo the inside in order to charge them more rent if they're there. You've got, what's the likelihood of default, right? How likely is that set of tenants going to be to just up and leave? Now, if they're on Section 8, the likelihood of default is very, very, very small. But the likelihood of renewal is probably also small, but the rents are being kept down, right? But if you've got a very huge luxury building with all sorts of upgrades already done, the likelihood of default may not be very good, be very big, depending on the credit of your tenant, but it could be very high. And so this is all pieces that we're going into your financial analysis. And we'll talk about where those fit in just a minute. We've got the demographics of the city or the location. Those evolve over time. We talk about urbanization and how the gentrification and things like that as they continue to expand. But what about demographics like the job base? You could have a luxury a good example of this is Flint, Michigan, right? So right before GM left, Flint, Michigan was a booming town, huge opportunity, great place. If you own an apartment building in Flint, Michigan, your tenants had an extremely low likelihood of default, an extremely high likelihood of renewal, great demographics, great job growth, and then GM decided to leave. What about the demographics of where that property is located now? Are the demographics going to be good? Or are they going to be bad? What are we seeing for the future? That could change a lot, right? If we're telling our investors, well, is that we have fantastic demographics, we've got all this job growth, what happens if that job growth doesn't occur? And then we've got other things like the assessed value. Depending on where your property is located, property taxes can change on the assessed value, right? So that may be a big wallop that could happen where it could change everything. And so what are those components that really make up what the future holds for this property? Well, a lot of times we care a lot about rents, right? Rent growth means higher values of the property. So in terms of rents, what are the facts as it relates to rents? Well, we've got historical facts, right? So we have your historical terms that have been successful. You have historical vacancies. You have historical rents. And you have your historical turnovers. And you have your historicals times the lease. Time to lease. But what about the future? What are the assumptions that we make? Well, when we're talking about rents, those future rents, almost everything about it is an assumption that we're making. And those can radically shift things. And we'll see how that's just an enormous lever. All of these things are enormous levers that can move everything for how things are portrayed. So, so we've got things like your future terms. What terms are you going to be able to offer? What vacancy is it? So let's talk about vacancy real quick. So in Houston right now, which is where Apple's Way took place, right? So Apple's Way is sort of the basis that I've been communicating about this webinar to you. Apple's Way had basically bought a huge number of doors. It was something like 2,000 doors in Houston on multiple properties. And they made a set of assumptions. And I happen to have found a video. If you look up Apple's Way in their Facebook page, you'll be able to see the video that they've left on. And he's talking about the deal that they're doing and what he's projecting to do. And he's saying, well, we've got a tremendous great vacancy rate is one of the anchors that he's been talking about. The vacancy has been always historically low in Houston, but actually that's not true. There was an article in CoStar today that came out exactly on this topic. And the article said that vacancy amount in Houston is actually going up, and it's going up pretty dramatically. Now, why is that? Why is Houston's vacancy going up so much? Because they have a good job area, right? So it's a good state. It's got low taxes. Why is their vacancy going up? It's because all the developers have been coming in and building all this product. And so there's now all this brand new product that's great there to do. And that's exactly what Apple's Way didn't count on, right? So they were projecting that they were going to buy this building. They're going to buy these sets of buildings, and they were going to be just like the shining gold star. And that rents were going to be driven up. They were going to drive up rents by improving properties by adding about $3,000 of improvements inside each property. And they were going to be able to charge between $200 and $300 more per month for those properties. So immediately in 10 months, they were going to be making, it was going to make the turn, and they could have all this increase in value, right? So there was this hidden value that was there. But then, so they were saying, well, our rents are going to go sky high, and that's how we're going to be able to get you, I think it was a 24.7 IRR. And we'll go into that in a little bit more detail, all right? So they were predicting that. But what really was going on at the same time is it wasn't rents that were going up, it was vacancy that was going up. And what happens when the supply goes up? Demand goes down, right? And so rents go down. So rents were actually being depressed because there was a lot of new product out there. And these regular apartment buildings, there was really nothing special at all. And they weren't very attractive. I mean, these were not the luxury apartments that they were trying to build them out at. So there was no way there were people were going to say, well, gee, I'm going to pay more rent in these places rather than go across the street, go to the brand new building with the well-known operator who makes everything fantastic for me at the same rent that I was paying before Apple's Way raised their rents. So vacancy has been going up. Other future terms we talked about is, what are those future rents going to be able to do? Are we going to be able to charge those additional $200 or $300 a month in terms of rent? That's a lot of the problem that we see. Turnover. Now, I don't know about specifically what the turnover rules are in Texas, but let's assume that it was okay, that they were able to move tenants out and improve property, improve the occupancy, improve the level of improvement so they could demand more rent. Well, what happens when those tenants wanted to stay, right? So you either have a choice between improving their property, but they're going to be demanding less rent, or if they're going to be having that problem anyway, where people are going to be improving their own space, why wouldn't they just move across the street into the nicer building? And then time to lease. When you've got a huge glut of properties that are vacant, right? And that are lowering rents in order to induce people to come in, it causes a huge existing problem. And then also what was trying to be done is capital improvements, not only to the interior, but to the exterior. Now, capital improvements might get some people to go and stay in those places, but unless it's something like that's really improving the look, like refacing a building, it's not the kind of thing that people are going to say, wow, they have brand new air conditioners. Most people looking for rents are just expecting an air conditioner that works. And so we have an expectation as a fact of the existing capital condition. Right. So we know what the working condition is basically of those. But if I'm planning to do a future capital improvement, I'm guessing on a few things. I'm guessing not only on what the cost is going to be at the end of the day, right? I might get bids, but it doesn't mean that's actually the cost. Anybody who's done improvements knows that the cost that you get at first isn't the cost you're going to get at the end. Time is extremely not the same thing, right? It's always going to be done in a week, but it never is. And then you also had the actual value, or the intrinsic value, let's call it, that was being added to the property by that work. You're guessing that the improvements you're going to make are going to induce people in order to want to stay more. And so that's sort of the background as it relates to how the facts and assumptions are playing off each other, right? So the facts, you've got a purely, existing thing. This is it as it is today. This is the building as it is today. But then as we have the factor of time factored in, this is why this is a pro forma. Right? Because we're making guesses, we're making assumptions about what's going to happen in the future. So let's talk about the four-step method of financial analysis. This is something that I came up with, a way to look at it when I was coaching people. So I used to coach people on how to do real estate syndication. And so I wanted a method to be able to show people the steps that I think about things when I'm putting together a financial forecast and being able to talk about it with investors. And as I did that, I discovered along the way that actually it's more than just step by, a series of blocks. There's actually little levers inside every single piece of it, which moves the dial in order for investors' return that they'll ultimately get and the amount of money that you'll get. So let's go through it. So we start with basic facts and assumptions. So our inputs here are obviously the facts, those assumptions that we're making, and market data. Right? Those all feed into what our basic facts and assumptions are. We can't even come up with anything until we've got that, until we know what the property is. I mean, it's got to be located somewhere. We need to know the square feet. We need to know those things in order to even begin to do a financial analysis. So first, we need to gather up all those. The next step that we have to do is we calculate our NOI and our potential value. So NOI in and of itself is and should be considered to be an objective measure. So NOI is an objective measure because we should have a very set amount of what the rents are today that we have. This isn't a pro forma. This is the NOI of today. So I know that my rents for last month was X number of dollars. I know that I've got operating expenses every year of X number of dollars. It's very set in stone, right? So I know what those things are. It's my income minus my operating expenses is my net operating income. Those are things that are non-negotiable. They're things that aren't going aren't up for assumption. They're there in every property analysis, which is nice because that makes NOI a very objective measure as it relates to that. And then we can figure out the potential value by using this market data to come up with a capitalization rate and come up with the potential value, right? So if properties in the exact similar condition, in the exact same kind of situation, with the exact same kind of income structures, with our costs in line, all those things, we can kind of work with those together and make it as objective as possible. Now, granted, potential value isn't 100% across the board objective, but it can be pretty darn objective if you're using market data and using it in a very objective manner, if you're looking at it that way. And that's the way appraisers work. I mean, that's how they come up with an objective an objective value of the property. So our inputs here is our rent roll. Our income, maybe it's other income. If it's an apartment building, we've got laundry. Maybe there's some parking that we charge additionally for, things like that. Interestingly enough, this is also one of the levers that Apple's Way fell prey to. They made an assumption that, okay, well, we've got this existing rent roll, right? So we know who these tenants are right now. But they made a bet that, well, and if you can see this in their marketing material. If you go use like Internet Time Machine or something like that, you can see that what they're actually saying is that, well, our rents are actually at, I think it was like 85%, but we're going to say that the property is undervalued because surely we could get this property immediately up to what the market vacancy was at the time, which I think is 92%. And I could be totally off. That's just from memory. So I think so they're saying, okay, there's automatically a 7% bump. Well, there may be other factors, objective factors on why those properties just didn't have the kind of tenancy that all the other buildings did, because they were older buildings that were not as attractive and were still charging relatively high rents, is probably one that they should have taken into account. But it wasn't. And they were also saying, and on top of that, we're going to have this other income amount, and we're going to just say immediately we can charge $30 a parking space a month. Well, I don't know the Houston market, but a lot of markets, you can't just automatically charge for parking. It doesn't happen. They're not going to take it. You go to a market like San Francisco or New York, or probably even like downtown Dallas, or probably downtown Houston, and maybe you could charge. But these weren't downtown like luxury apartments where you could just automatically charge that. This was middle income, regular, not very attractive garden style apartments. And then they've got OpEx, their operating expenses. So they said that they were going to they weren't going to be counting their operating expenses really at the same level either, because they were going to be saving water, and that was going to be saving 30% off of that's the example that he used in the video. They're going to be saving 30% off their water bill because they were going to be saving water. Well, even still, that puts in a lot of tenant improvements, or a lot of improvements that need to happen, a lot of capital improvements, even to save some water. And 30% is a pretty high number for a savings on water. But these are the factors that go into, that feed into NOI. So the next piece of it, and the 4 steps, is an analysis of cash flow. And now cash flow, it comes after the point in time of NOI. And why is that? Well, suddenly now we have a mortgage on the property, right? We may have debt. And if there's debt, then suddenly now we also have debt isn't an objective measure, right? Some people can get very, very cheap debt. Some people can get very expensive debt. Some people don't do debt at all. Some people lever it as much as they can. So it's not objective. And so debt plays a huge role in that. There's also other factors that that affect it. And so you'll see that these things start to get more and more assumption-y the higher up chain we go, because we have debt here as an input there. We've also got fees, right? We've got your fees are starting to come into play. As syndicator, you're charging fees. Your money comes from two sources. It comes from fees and it comes from that split of equity, right? So that equity gain is part of it. But what happens before that piece is fees. So the amount that you're being paid as an asset management fee, that comes before the cash flow number. We also have capital improvements. Right? They're not a part of NOI, so they're part of cash flow. We also have the amount that's being held back in reserves. Every dollar that's held in reserve is considered cash drag, right? Because you've got this dollar that you've basically is sitting in the bank should you need it, and it's not able to act as a machine and make money for you, right? It's not an invested piece. Suppose you could put it in a CD, but it's not going to be making the same kind of returns. So those are the inputs into cash flow. And then the last step is performance. And now here, this is where in your financial analysis, so this isn't a linear thing of that takes place. I should remark now. This isn't a piece of this happens, then this happens, then this happens. They sort of go together in that same general direction, but they're taking place at very different levels and very different thought processes, which is why I write it like this, because it kind of gets higher level thinking as you go, rather than into the weeds. Right, our basic facts is about as into the weeds as we can get, because that's the piece right there. The square footage is 10,968 square feet. That's it, right? It's not changing at all. But when we get to cash flow, it's like, well, we might take debt, we might not. Or I might charge a 1% asset management fee, and I might charge a 1.5% asset management fee. So it becomes a lot more loose, and it becomes a lot more like we're manipulating those levers in order to see where we can drive value. So what happens up here as our inputs? We've got our purchase price, and we've got our sale price, our estimated sale price. We've got prefs, if that's how you're doing it. We're going to assume that you are, just because it's easier to talk about it in this context here. These are all inputs into performance. So here, this is the big picture as it relates to, what that overall piece looks like, right? So we've got a set of facts that feeds into the calculating NOI, which feeds into the calculating of cash flow, which feeds into the calculating of performance. So let me go just quickly back through. I was writing down the sizes of the property, the facts, things like that. And then this shows that plan. So we go from that basic facts and assumptions here. We go up to the net NOI and potential value here, cash flow here, performance here. The fact that the whiteboard wasn't sharing isn't a crisis, so we've got this. But I'm assuming you see it now. There we go. Okay, perfect. Good. I'm glad you see it. So let's keep going. So now, there's different, as I was saying before, there's different levers on how we can change all this. And we're going to talk about this in terms of not only in terms of what you can do in order to shape your things and how you can talk to your investors and things like that, but I also want to backstop it with things like that some of the gurus are doing when they put together a syndication, or some of the things certainly that Applesway did. So we'll go through that. Let me open up. There we go. Okay. So what are our levers in NOI, right? So we've got and this is important because when we're coming up with the potential value, we've got obviously got NOI divided by cap rate equals value, right? So that's the calculation of value. So the higher my NOI is, the more value ultimately I'm going to have. And the lower the cap rate is, the better I'm going to have that. Well, so on this top line, the things that move NOI is obviously your income. The higher the income, the more valuable it is, right? So I'm incented to make sure that I'm projecting my income fairly and making sure that it's as high as possible but accurate, right? So I don't want to leave things out in terms of my income. I don't want to leave out other income, for example. But I also don't want to create a situation where, like what Apple's Way did, I'm making up income that didn't exist. I was saying income that might exist as part of my value, and that's why the value was so incredibly under market. So income minus expenses, right? My expenses are another piece of it. So as my expenses are down, so is my the value of my as my expenses are down, so also is my total NOI going up, right? The higher I can make that number. I also have to figure in other things. If I'm going to mark things to market, then I also need to take into consideration my vacancy. And is that a stable number, right? If I'm saying my vacancy is 85%, can I say that that is the vacancy that it is today? Now, is it fair to say that, well, we know that it can go to 95%? Well, certainly if you had a tenant already signed a lease, you probably would, right? And you'd probably use that as a big factor. And then you've got the other one that, as it relates to your fees, is property management. Property management fees are available for you to take if you decide to do the property management, and a lot of our syndicators do, right? A lot of syndicators are property management companies that decide to syndicate, and basically what they're doing is they're building out more business for themselves because they're going to be the property management company. Totally legit. They should do it. They're doing great. That's a great idea. But it's also a lever, right? Because how much are we charging for property management? Occasionally, when I'm talking to syndicators and we're talking about what the property management will be, I hear things like, "Well, it's a triple net property, but we're going to charge 8% on property management." I mean, 8% is not the property management fee of a triple net. You know, it should be on a single tenant triple net, it should be like 2, if that. And on a retail building, maybe 4 or 4.5, maybe as much as 5 if there's complex things going on. And this is not in a mall context. I'm talking about smaller triple nets. So then the other thing that's driving up value is your cap rate. And this is obviously a little bit more assumptioning, right? So I'm looking at, okay, well, what are the other properties in there? You know, one of my mentors, many years ago, what he told me to do is you have to walk every comp, right? So you have to get out, you have to get out of your car, you first have to drive to them, and then walk every single comp and get a feel for them. And it makes a huge difference. And when you lay it out and you start looking at all the comps in comparison to yours and build a matrix, then you start seeing, oh, okay, this is how my property really sits. And this is why that building is much better in this respect, but maybe it's not as good in this respect. And that's how cap rate kind of changes. Again, it's exactly the same thing that an appraiser does in order to come up with what cap rate to use in order to come up with value when they're using the income approach. So those are the levers as it relates to NOI, right? As it relates to cash flow, now we've got NOI itself is a lever, right? Cash flow levers. NOI is a lever, right? Because the higher the NOI that we're using, the more cash flow we have at the end of the day. Debt and how that's going to function is a major lever, right? If I have an interest-only loan, that's going to automatically give me more cash flow than one at the exact same interest rate as a one that's paying off the principal. I may have some other things happen because the interest only period may only be for a short period, but it's going to change that cash picture. It's going to change the tax picture of how it happens and how things get passed on to my onto my investors. Right? If I'm taking the value of and paying down my principal, well, that principal payment amount isn't going to be tax deductible by my investors in their taxes. The CapEx that I plan on doing. And then here's the big one, fees. We've got your asset management fees. Right? So I have a huge range of clients who have all sorts of different asset management fees, and all of them are legit. We go through them all, and we make sure that they're in line. And when they choose a higher number, they know what they're doing. They're choosing a higher number because it's well supported. Like if I was doing a development piece, I would choose a higher asset management piece myself because it's going to take more work. It's going to take more communication about that asset piece itself. On top of that, speaking of development, we have construction fees. Right? Your construction fees can be, as high as 10% of soft and hard costs, sometimes even more. And that's not counting the developer fees themselves. The amount that we hold back in reserves. If I don't hold anything back in reserves, I buy the property for $1 million and I decide we're going to have 0 reserves. Well, that's going to be a very different cash picture than me saying, well, I'm also going to hold 20% back in reserve in the cash flow in order to put them into reserves. That's just it'll obviously have a 20% effect on what the cash flow looks like. And then cash flow is a forward-looking thing. Where do I see growth happening? Do I see that happening, and how's that going to play out? When it comes to a syndication, we've got distributions. Now, this also plays into play in terms of performance. We'll talk about that in a minute. But distributions make a huge difference when it relates to cash flow. Because if I make a distribution, if I'm making monthly distributions, right, and these are my months, and then per unit, I decide to distribute in month 1, I decide to distribute $2. In month 2, I decide to distribute $1. Month 3, I decide to distribute $3. And then month 4, again, I decide to distribute $2. And it's going to make a different cash flow situation. That's certainly going to make a different impression on my investors than if I just did really the exact same amount of $2 every single month. But if growth has a play in this as well, because if I make this decision that, well, here in month 1 where I'm making a $2 distribution, I'm banking on that I'm not going to have another period in month 3 and month 4 where suddenly I'm only going to be able to distribute $1 again. So it has a long-term effect on how cash flow works. And then, of course, your performance measures. And this is ultimately what your investors see. So this has your cash flow as a lever, which your NOI is a lever because it was before. The price that you bought the property for is a lever in the overall performance, right? Because it's how much money is it going to cost? How much money do you need to raise in order to put together the syndication? And how much money ultimately is that value, right? So that if the property it costs $1 million versus $500,000, but it's for the same amount of cash flow, well, certainly you better choose the $500,000 than the $1 million. Just for performance sakes alone. Then you've got your projected sales price. How assumption-y can you get? I mean, we have no idea what the sales price is ultimately going to be. We make guesses based on our assumptions, and if you make your assumptions fairly clear early on that this is what it's going to look like, then you can start to build these levers. If your levers are all in line with pretty much normal, you can come up with a reasonable sales price. But what Apple's Way had projected it was going to do was it said, well, our sales price is we're going to double your money in 2 to 3 years. And all of the properties I've ever done before, I did it in 2 years. That's what he said. Well, that's a huge jump in sales price. And so in order to necessitate that sales price, they have to, radically drive up NOI. I mean, it better go through the roof, and we better be crushing that cap rate. Right? It better be just demolishingly crushed to double it in that short a period of time. Now, you had the cash flow of the rents beforehand, but so it wasn't in full, that kind of appreciation. It wasn't full double your money in 2 years, but still, it's probably 40% per year. So that's a lot. So you've got your sales price. Then, of course, you've got your splits. Oops, let's pretend I can spell. Prefs, etc. Right? So, if I'm paying out a big pref, that's a large amount of money that's going to my investors right off the bat. If I have a preferred return of 12%, that's a pretty big preferred return. I don't really see 12% preferred returns outside of like fundraising for debt. If it was, but a preferred return of 12 and like a, 80-20 split, wow, you're giving a lot of money to the investor. So the performance is going to look good. So at the end of the day, maybe you can advertise that. But could you also advertise a lot better? What if you did an 8% preferred return, which is fairly common and not unusual, and you decided to do, maybe you wanted to keep the 80-20 split, whatever, and it translated to still a 15% IRR. So it's all that series of levers is what leads to this deal. And that's the problem that I'm talking about, is because you're leading to this number. But the assumption that is being made here is not only how we get here, right? It's not only how we get there, but it's also that that's what the investors care about. At the end of the day, an investor, if Bernie Madoff went to an investor and said, "Hi, my name is Bernie Madoff. I've got this great deal for you. I'm going to give you a 12% preferred return. I'm going to give you a 90-10 split, and it's going to give you an IRR of 40%. Are they going to do it? No, they're not going to do it. And that's the key difference, is that and that's what's forgotten in every single Facebook ad I've ever seen for an investment, is it's making the assumption that this is all that investors care about. And it's not. It's not at all. What investors care about is you. They want to know why they should invest with you, not why are you going to get me this number at the end of the day. They want to know why you. And so that makes all the difference. So, I have a lot of clients who will put together, very complicated pitch decks. And I've, one of my great clients, he sent me a pitch deck long after I'd been working with him. And it's like 20 pages of solid text. Well, nobody's going to read it. And now it was very well backed and everything was very scientific. But that isn't why he was so successful. I mean, there's no way that that's not what investors care about at the end of the day. They knew who he was. He had a very good reputation in the community, or does have a very good reputation in the community. He has a track record that's unbelievable. He has, he has many, 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 many millions under management. So he knows what he's doing. That's why people were investing with him, not because his pitch deck from the beginning was very short. By the end, it grew to this monstrosity because he thought he needed to answer every question in every pitch deck. And it's just not the case. At the end of the day, the investor invests in the person and in the idea that you're selling them. I represent companies, so we put together PPMs and all those things for businesses as well. And the businesses that do terrific, they do terrific because of one of two things. They do terrific either because the management team is phenomenal and they have a great reputation, right? So these are people who it's like, oh, I know who that person is. So they can raise money with that. And they're hanging their hat on that. And so the product itself may not be very interesting. Some of the products that they're raising money for are kind of dull. Not the kind of things that you'd be like, wow, that's great. But the people who are running it, they're people I've heard of. They're people who are interesting. They're people you see on the media, right? Those are the people, they don't have trouble raising money. The other businesses that do very well raising money is they come up with a really cool idea. So we have companies that are very, very small, that don't have a huge track record. But the idea is really cool, right? It's something that, you know, if it was on Shark Tank, every one of the sharks would be fighting over because it's such a great idea. So those people don't have any problem raising money either. But that doesn't mean it's not the same exact case for real estate as well. Because real estate, I mean, if you're buying a building in the middle of town that doesn't, you know, and it's got this boring return and there's nothing interesting at all about it, well, you better make something interesting because you're not going to have a very easy time finding investors. If you make something and really explain why this is a good deal beyond all of this, then maybe you're going to have something that's good. And so that's the piece that's kind of missing, is that these most of the syndicators are relying on these sets of numbers here. But then they see the gurus who are putting together packages. And what the problem with a lot of the gurus, so aside from Apple's Way, so excuse me one sec. Some of the more famous syndicators may be putting out numbers that are the same as this, but once you get their PPMs, and I have, and you start seeing what they're doing, they're not getting that. The investors aren't getting that. They're counting on their persuasive ability in order to get that. There's buyback rights that are very onerous to the investor. If you look up some of these people and you look on some of the forums of, you know, other investors and, you know, read about what people are talking about them, you know, they're getting returns of maybe 2%, maybe 3%. What's even worse, though, is they probably could get returns, because I've read the PPMs, they could get returns that were negative because of buyback rights. So some of them have buyback rights that say, well, we can buy it. We reserve the right to buy back your property at 70% of the value put into it. And they're getting it, and they'll fill up very, very quickly. Or they'll put into product types that are, you know, midtown office products that, you know, wow, right now you're going to do an office project? Great. Good luck. So that's kind of that's my spiel on underwriting. So I hope that helped. Let me take a chance to look at some of the questions. Great. If I invest as a preferred loan, Class B share, is investment on personal name or company better? The investment itself is when an investor's coming in and they're making it investing into debt. They're investing making a bet that you are going to be able to deliver that kind of return. Because at the end of the day, they don't really have equity to bank on, right? So they have to believe in you first and foremost, because they don't really have anything at the end of the day. So they need to make sure that you are going to be able to deliver on it. Now, yes, the company itself has backing behind it too, but really they're counting on you or the management team in order to do that. the legal structure for investing in properties in different states is exactly the same. So our legal structure is always, you know, we're dealing with the federal system. So our structure is always going to be under Reg D, 506B or 506C. It's going to be, you know, you've got, oops, I drew that wrong. You've got your sponsor entity here, and you've got your investment entity here, which actually I'll draw as a building. We'll say it's just a one property thing. And your investors all invest here, and the sponsor manages that in exchange for management fees. That's the very basic structure about how these are put together. All right, good. There's a question about whether or not this whole structure, you know, how do you apply it in terms of, you know, putting together a syndication? So when you're putting together, when you're deciding on whether or not to move forward on a property, this ultimately, at the end of the day, you want to be able to give a number, right? Because your investors are expecting this. They still need to know, you know, what sort of returns they're getting. But then to use these other measures here, it's ultimately, how do I move those levers? And this is how I start every single time. So if you were, you know, next to me when I was doing an analysis for the next project I'm working on, you would see basically I've got a series of options available to me and in my spreadsheet, and then I'm building out. First, I build out a cash flow statement of just complete cash flow. Like, I bought this cash. Ultimately, I want to get to NOI, and I want to look at what the basic facts and assumptions are. You know, where are those? Am I middle of the road? I always steer it to the middle of the road. So that's where I start. And then if I just put together a simple structure, what kind of returns am I talking about? So if I come up with, okay, at the end of the day, with just all cash, I'm getting a preferred return. I'm getting a return of maybe 15% IRR with 8% pref and a 70-30 split to my investors with no debt. Okay, well, then I know automatically, and depending on the property type, based on debt costs now. So this used to be very easy when debt costs were much lower. So before, it was you automatically would just put on debt, and it would your returns would go up. That doesn't happen nowadays. So if I'm doing 15%, though, I would guess if I could get debt below 10, or at, you know, somewhere in that ballpark, I'm going to be able to make more money for my investors. And so I'd start to, you know, put that on. The more money I make to my investors, the more money I can make for myself. So I'm always trying to balance that, right? I want to be able to over deliver a little bit to the investors, and make the most amount of money I can as a syndicator. Another question: the sponsor has an ownership interest in both entities, correct? Yes, yeah, absolutely. Or many times. It doesn't have to be that way. So a lot of times, so this is you here as the person. So this entity here, this sponsorship entity that exists, its whole purpose is in order to protect you from investors, ultimately, or from the deal going south and getting sued. So it's an asset protection vehicle. It's also easier in order to manage the investment, but the main purpose really is that protection. Now, most of the time, if you wanted to invest as well, I would put you all the way here as an LP, personally investing into that investment entity. And that would be the way we'd do it. Great. Looks like right on time. Are there any other questions? I got time for one more, probably. I know it's a lot to digest, and I talk fast. So I will be making this recording live available. But what I mostly wanted to do was be able to share with you sort of how I think about underwriting, because we're entering into a whole new phase of economics, in this country, right? We've got higher interest rates. So the old days of very low interest rates are gone. We've got majorly shifting dynamics, not only in economics. I mean, we have, some areas of the country are growing rapidly, other areas are not growing at all. Other places are leaving, traditional good places, but there are people leaving. So there's major shifts that are happening, not only in that sector, but also in terms of what the general interest is, right? So no longer is it going to be, office used to be a terrific, office is a great example, because I've done few office projects. Office was wonderful. It was great. It was stable. It was easy. It's a great product type. But now office I wouldn't touch at all unless I had a great alternative exit. If I had an opportunity to buy an office building at a huge discount and I knew I could turn that into a profitable conversion into multifamily, something like that, I'd do it. But the estimate right now that we're seeing, from the industry people who make those sort of estimates is probably at most 20% of those could be converted into multifamily. So and I don't know that world enough to be able to tell which is going to be 20% and which is going to be 80%. But like I said, we have a lot of changing demographics, but right now, this is the time to start syndicating. There are tons of opportunities that are opening up. And there are tons of opportunities when you're competing, not on numbers, when you're competing at the level of, when you're competing just for prefs, splits, and IRRs, it's a scramble. You're a commodity, and there are going to be winners and losers. But when you're competing based on you and you're making it your brand, it's a whole different ballgame. I mean, that's why some of the gurus are able to raise so much money so quickly. But it's not just the gurus. One of my earliest clients, he owns many, many billions under management. It takes him less than 24 hours. In the last project, he raised $200 million in like 3 hours. So he hit go on send the email and had $200 million like in 3 hours. It was insane. And that's the kind of thing that people can compete for, while other people are struggling to raise $2 million because they're competing on, I've got an 8% preferred return with an 80-20 split and giving a 15% IRR. That's not how you ultimately be successful at competing. Now, if you've already got that network, that's great, because that's automatically giving you the leg up and people investing in you. So thanks for taking the time to meet with me today. Again, I'm Tilda Moschetti Syndication Law Group. You know that by now. And if you're looking to start your syndication, we're a law firm that does more than just help put together. We don't just put together a private placement memorandum and all those documents for you, but we're also here to, I want you to be successful. I want to help you reach your goals and be, think long term and really grow that company into something big. And if I can be a part of that and helping you grow that, not with equity, but helping you grow that by, offering a little something in terms of advice or something like that, that would be great. That'll make me sleep even better at night. So thanks again for taking the time, and I hope you enjoyed this webinar.